Well, joining us right now in the studio is two very special guests. Vikas Pershad, Portfolio Manager, Asia Equities at M&G Investments, and with him, Deepika Mundra, Director at M&G Investments. Vikas, Deepika, thank you both of you for taking the time out and joining in. So what has changed, Vikas, from the last trip that you guys were here? Was that in Feb, right? You said that India was the cheapest market. Do you still say that, looking at the screen?
Well, yes. So always a pleasure to be here. I'll just start by saying when we were here in February, one thing that we said is, if you look at the equity markets, you can't call India an emerging market anymore. It has emerged. How much more do you need it to emerge? It's here, one of the 3 or 4 largest markets in the world, 3 or 4 largest economies in the world, 6,000 listed companies, the busiest ECM market in the world. So that was my view then. Deepika and I have had 30, 35 meetings between us over the past 2 weeks that I've been here. I now remain convinced that for the next 5, 10, 15 years, it is the cheapest market in the world. You can look at a 1-year PE forward multiple on the market and say, well, this is very high in the context of the past. We'll look at China's multiple, look at Korea's multiple. And there are merits to those other markets as well. But you have to look at what the multiple becomes. And you have to look at the opportunity set here. A multiple doesn't define cheapness. It's the discount to intrinsic value. The intrinsic value of the Indian equity market is multiples of what it is today. So you do your homework, you bet right, you sit tight, and let time and the companies do the work for you.
But if one really looks at the way how the earnings trajectory is moving, last 2 or 3 quarters, we've hardly got any upgrades. It's been more downgrades, and the base effect has started kicking in. And given there where liquidity conditions are, what Reserve Bank of India is doing in trying to really go after unsecured loans, don't you fear that in the near term there could be a case for earnings downgrade and the valuations could come under check?
Well, this is the benefit of being an active manager. We're not buying the market. We don't invest in the market. We invest in companies. And when you have a universe as large as this now, 6,000 listed companies, over $100 million market cap, the number's approaching 2,000 companies. And there's plenty of dispersion within sectors. So you do your homework. We find, if you look at our portfolio today, largely it's not changed very much from the start of the year. Less PSUs, less some of this, a little bit more of that. But our companies are benefiting from earnings upgrades, and they're benefiting from re-ratings still. So I think it depends where you're looking. There's still plenty of opportunities. We were in Gujarat last week. We met an industrial company trading on mid-teens earnings, 2 years out, leader in its space, gear maker. Earnings will accelerate. They should re-rate. And so we're happy to be in companies like that.
Deepika, you guys have met, what, 30, if not more companies in the last 2 weeks, right? Almost an India roadshow of yours. What's the collective India stack telling you? I mean, what have been your observations? Because pretty much you've run through the entire span of the country.
Yeah. So some of the common things that we've picked up on this trip across meetings, one is, I think last time when we were here in February, also we highlighted some of the recovery plays, whether it's industrials, capex, commercial vehicles. We see some of those things still being largely intact. So just from which areas of the economy are growing, some of those recovery plays still are. So some of the cyclicals we still like, and that's reflected in the portfolio as well. The other things that I think common threads that we've picked up is premiumization. So we see a lot of demand for higher end consumption, whether it's hotels, airlines. India's largest airline after 17 years of operations is adding business class seats, right? Never happened before. Clearly they're seeing something different in terms of consumption patterns, and that's taking place. Luxury real estate being picked up pretty quickly. So premiumization, some of the cyclical recovery still, so construction and as well as engineering goods. And lastly, I would say Make in India. So we've heard of Make in India repeatedly again, but what we're seeing is a lot of self-help from companies trying to either improve productivity or looking at export markets, mining those markets. And some of it is policy, some of it is some trade barriers, but a lot of it is also global companies looking at diversification of supply chain. So I think from just hearing those things last year, this time we started to see some evidence of that coming through in terms of orders for either industrial component makers or for cables and wires companies. So these are the 3 things I would say that we've picked up.
The differentiating factor for India right now is the liquidity. Net TI plus domestic plus pension FI put together, it's about $6 to $7 billion on a monthly basis of net flows. Now, typically when that happens, the good ideas, they get mispriced. Is that the fear in India that earnings will grow, but it is like saying gold is now available at the price of diamond, or gold is still available at the price of diamond? How would you assess it?
I think we can share a combination of thoughts over here. But like Vikas said earlier, right, we're not investing in the full market. So yes, the job is harder. And as active managers, the point is to figure out companies within the same sectors which are doing well, but then concentrate your bets. And I think that is something which is very evident, whether you look at autos, IT services, financials, the last 12 to 18 months, just within the sector, there has been so much dispersion of stock performance. And that's, I think you have to do a lot more work today than what you would have thought just as a India, just buy India, essentially. So whether gold is available at the price of diamonds, in certain cases, yes, there are a lot of companies which are available at 70, 80, 100 PE. And while we don't want to focus just on the 1 year forward PE, some of these companies, it looks very difficult that they will materially outperform the market. So from a relative basis, yes, some of those stocks are difficult to play at the moment. But if you look wider, I think it's possible.
I actually think we're buying a lot of Sona at Chandi ke bhao in the market today.
Give me an example.
Well, some of the private sector banks that had underperformed, but also in the small and mid-cap space. I mentioned this gear maker that we have. When we added to the air conditioner supply chain, one of the makers there, still, if you look at the long term, we met some of the power companies in Gujarat and in Delhi last week, and less than data centers, they were talking about air conditioner related power demand and the infrastructure required for that. India's air conditioner penetration is less than 10%. Whether it's 6 or 8 doesn't matter. It's headed towards 20, 30, 40, 50. So when you think about the affordability that brings, the power infrastructure that needs, you look at that entire supply chain. We've met companies in the T&D space also, transmission, distribution, less on the generation side. That whole supply chain, for the long term, this opportunity is going to be around for a very long time.
But, you know, like Deepika was saying, that the job is more and more difficult right now. It's a well-discovered market. You know that you are paying, what did you say, Sona Chandi ke bhao. But yeah, closing in at least on the Sone ke bhao, which are also at an all-time high.
Yeah.
So how do you make that distinction on whether to add to the existing positions or, buy stocks of a fresh company?
So this is one of my favorite questions. I'll say 2 things about the portfolio. Number one, if you look over the last 2 years, one thing that has really helped us is we have been fully deployed. Cash in the portfolio has been 0 for 2 years. And part of it, we see that as our job and as our responsibility, but we have seen ideas. So there's been no cash drag on the portfolio, we've been fully deployed. Second, the way we look at it is if we think something is interesting and it starts to rally, we ask ourselves the question, honestly, if we already owned it, and would we sell it here? If the answer is no, then it's the exact same thing as buying. The converse is also true. Let's say something has a earnings miss, management change, strategy fails, stock falls, and if it's falling, if we wouldn't buy it at that price, then we should be getting out. So that's how we think about it. So that helps us keep us fully deployed. It lets us hold on to stocks for the long term. And because also the sizes of the positions have grown such that we can't be in and out of names. And so that also helps us stay in names. Actually, I'll add a third point. If you look at the portfolio today compared to 2 years ago, we had a lot of small positions that we thought we were wary that these names are small in the benchmark, but if we're zero weight, they could go up 2, 3, 4, 5x. Now that the market is up as much as it is, we have fewer small positions because from here we feel that some of those multipliers are less likely to happen. If you look at one of the leading retail companies, just yesterday, a brokerage upgraded it to a buy after it's gone from about 10 basis points in the benchmark to 100 in the last year. The stock is up 6x, right? I don't see many of their stores, but we feel that the probability that something like that could hurt us is less here. So we have fewer names in the portfolio now. Still no cash, fewer names, holding on to things for the long term.
But consciously, is it now time to orient the anchoring of the portfolio, which is that last 2-3 years, if you bought into PSUs, you've hit a home run. If you bought into engineering, defense, shipyard, it's been a good run. But now increasingly, those businesses are trading at just in and around fair value. And looking at the construct of the world also, where risk-off movements are coming back now, is it time now to have a defensive stance in the portfolio?
So, again, gap to intrinsic value is what we think. So let's say you took defense as an example. Now, defense is going to be a multi-year theme, right? We're not seeing defense spending coming down anytime soon. We're not seeing India's focus of indigenization going down anytime soon. Did the stocks reach fairly exuberant valuations? Yes. We, in fact, trimmed some of our defense exposure, which we were quite heavy on last year. But also execution misses took place. And this is what we had highlighted last time also, that order books are growing, they're multiplying. But these companies need to execute as well. But at the same time, I think this is going to go on for a long time, just in terms of order wins, of execution, defense companies continuing to do well. So I think there is a price for everything. So if you're a long-term shareholder, then some of these dislocations give you opportunities, I would say.
Deepika, you're here in India, so perhaps it would be more suitable to ask you this question. Do you sense that there is any sort of bubble in any segment of the market, be it SMEs or be it the IPO market? I mean, look at the kind of valuations that they come out with and still get more and more appetite and continue to double and triple from their listing price too.
Yeah, so the IPO activity has been hectic. It's kept us really busy as well. But the one thing about being fully deployed is you don't need to evaluate every single IPO. So the one thing that we're clearly staying away from is loss-making companies, especially companies which don't have a handle on profitability which they themselves can control. So these can be new age companies which were not there 5 years, 7 years ago in new sectors. They're great just in terms of the scale that they've built, but there is no sight of profitability. So I think those kind of things try to give you a sense that yes, there is some bubble or there is a lot of euphoria just because these companies have scaled rapidly in the last 4 to 5 years. But just setting up capacity, we think is not the right thing. There has to be a side to profitability. So I would say if we had to think about something that we're avoiding, it would be some of those areas. And we'll be focused in the IPO space on companies that are more niche, that are more focused on what they are doing rather than just one trend in their space. So to names that we have added, I'd say auto ancillaries is one, which we have had added to via the various QIPs and IPOs that have been happening.
And if there's a bubble, it's not in any particular sector, I think. Although you might have a question about renewables or some niche products, but it's in an asset class, which is volatility. The F&O market is something that we pay more attention to. So the inflows that Nikunj highlighted, they're very large and much larger than they were a year ago, but they're not astronomically large compared to recent levels, as is in the case of the F&O market. There will be more restrictions on that might pull some liquidity out. That probably has more an impact on the the SMID names.
Yeah.
But given our long-term horizon, then we will step in we have our lists ready to go. I think what will happen is that at some point we'll get a correction, and then people will say, is this still cheap? It'll
but
be
you
cheaper.
Don't have any cash?
Yeah. Well, actually, so what is defensive? Nikunj was asking about it. Are you positioned in defensive names? Defensiveness is derived from dislocation from intrinsic value, from the price that you're paying, rather than a particular sector. If you have a staples name that is barely growing top line, earnings maybe mid-single digits, trading at 70 times earnings, that to us is not a defensive, and we're zero weight in a lot of the staples names. But we are overweight, or we have off-benchmark names in the same space. If you take biscuits and cookies, for example, the large cap names, we're not there. But some of the smaller companies, we are there because we see genuine earnings growth. It's not in the price yet, smaller market caps. So defensiveness that's our interpretation of defensiveness. That's how we express it.
So let's look at a construct. I'll use 15% as a benchmark.
Sure.
Where do you think there could be scope for 15% earnings growth for next 3 to 4 years, CAGR?
Right.
Where do you see that happening? Which end of the market, which company, which sector do you think can grow above the nominal GDP of India? Because India's nominal GDP is 12-13%. So that is coming.
Right.
The trick is to beat that. Where do you see that happening, and which end of the market you see that happening?
So this is the question we ask ourselves all the time, is if you assume this same 15%, that implies a doubling in 5 years. We're looking for earnings growth rates and valuations that imply an equity can double in less than 5 years, because we're trying to beat the market. It's not just absolute returns. Deepika mentioned auto ancillaries. EMS in certain names. Now, we spent some time with some of the Delhi-based EMS companies last week. The revenue numbers are massive. The question is on margins. And what we've seen in Taiwan with some of the EMS companies there is that they can get the revenue, but the margins either get diluted, because if you're getting much larger ticket size items, if you're going from a general purpose data center to an AI data center, you can't put the same margin on that, because that implies many multiples of increased value. So in the EMS space, it will come, but not in all of them. We've seen margin hiccups in that space. Auto ancillaries, pharmaceuticals in some of the companies, some of the smaller ones. I mentioned the air conditioning companies there. There's that, there are plenty of others.
Yeah, some of the industrial names in particular, those which are export focused in particular, we see a lot of labor disruptions in Europe because of that business shifting to India to some extent. So industrials, I would say. Autos, I would still say you can still get double-digit earnings growth, particularly in the two-wheeler space. Those companies which are gaining market share, so that would be another one.
So we should also talk about where we won't see it, because in this market you can add value through what you own, but then also through what you don't own.
Of course.
So consumer staples, a lot of the PSUs, we don't see it. PSU banks in particular. IT services broadly, it'll be hard to get that kind of a earnings momentum. And then in healthcare, I mentioned pharma, but not all pharma. Hospitals, healthcare services, we probably will see.
Isn't hospital a very competitive space? I mean, they always have capex which is on. Competition is intensifying. There used to be this huge arbitrage where everybody from small town used to move to tier 1 cities for the healthcare needs. But now, given the way how money is moving into the healthcare sector, both private from PE, hospitals are mushrooming everywhere, and they have periodic capex which they keep on doing.
Yes.
So why do you like the healthcare space or the hospital space?
Well, it depends on where the footprint is. So some of the companies are in areas that are more competitive. So North India is quite competitive. You saw one of the leading Delhi-based hospital companies acquire the JP asset last week. And so competition is improving. That was up for bidding. They were not the only ones who wanted that. And so that part of the country will be more competitive. Now, there are some assets here that will come online in Bombay, in Worli, for example, a crown of an asset. And those are rare to come by. So it depends. You have to do your homework, as with any sector, but especially here now that you have so many choices at your disposal.
Deepika, power is such a big story, right, within the entire renewable stream, and you've been doing a lot of work there. What interests you? Because, I mean, everything from transmission to storage, the supply chain is huge.
Yeah, so power, I mean, across the board, when you talk to companies, you're seeing energy intensity go up, right? Whether it's more electric vehicles on the road, data centers being built in India, semiconductors someday in India. So all of these things are more energy intensive. So the demand for power is going to remain elevated, and utilization levels at the generation level are high. So which is driving the need for capex across all levels. You will see more generation capex, particularly renewables. I think that's already kicked off. The government has tried to simplify a lot of things in terms of bringing supply chain within the country itself so that execution gets a boost. But the space that we most like is the transmission space. We think it's fuel agnostic, execution is better, it's shorter term execution. If interest rates fall, again, that's something that benefits as a space. So transmission is the one we like most. I think since 2022, the transmission capex of the country has repeatedly increased. So every time the government comes up with a plan, they bump it up. And that's because the flow of generation of power is different. It's more renewables, which is more transmission intensive. So that's the one we like most.
So by wire companies, meter companies, cable companies, by companies which are putting the towers for transmission, that entire basket, so to speak, is that the approach?
Yes, so you can either take a developer, or because returns are fairly decent in the developer space as well, or you can buy anything in the value chain. We like both.
I'll like to draw your attention to a headline which came 2 weeks ago. BMW has given a profit warning. Porsche has given a profit warning. And I'm bringing it up because you just mentioned that you're confident about growth in auto ancillaries. Yeah. What makes you confident about auto ancillary when luxury car market globally per se is slowing down?
Yeah. So one is, of course, the headlines are there for everyone to see. We've seen them ourselves. We've asked and met a lot of auto ancillary companies in terms of seeing what their order book looks like. They have large order books, but will they materialize or not materialize? What we've seen is that the auto ancs in India have gone from tier 2 suppliers to tier 1 to tier 0.5 also. So they're actually becoming much larger partners with these OEMs. And because of that, there is a lot of opportunity to cross-sell. So they've continuously added products. Those who were only two-wheeler suppliers earlier are now doing two-wheelers, four-wheelers, as well as CVs. The four-wheelers, let's say, at an early stage, but growing. So those are the kind of companies that we like. One, that are no leverage, because that's difficult in this space to handle, because it is cyclical, like you rightly said, it's going to go through its cycle. And more importantly, those who are diversifying their product base based on their own engineering capabilities and productivity, keeping costs low. So there are fundamentally, I would say, still companies in the auto ang space, which we see that will grow faster potentially than some of the OEMs.
Can I just add one point? Several times Deepika has mentioned the word execution. And I've been doing this not as long as some of the guests that you have on the air, but long enough. And hats off to Indian entrepreneurs, business families, CEOs who are from outside families. The execution has been amazing. It's not like 20 years ago or coming out of the GFC. The treatment of minority shareholders, capital allocation has gotten so much better. And this is also what will drive value over the long term. If you pick your favorite search engine and you put in Motherson and M&G, a deal will come up that was announced last week. It's public, so we can talk about it. And it can be a transformational transaction for this Israeli company that was already in our portfolio, that we introduced to Motherson. And the way they did their diligence, the way they and others are evaluating these companies, it's much different than it was 10, 15, 20 years ago. We see much less empire building or chase for revenue or leveraged chase of revenue and very thoughtful capital allocation. And the execution is so much better now. And it will get better. This is not a fad. This is not a passing fad. Because people realize that we can have a large share of a small pie today, or we can, over time, have a same size slice, maybe even a little smaller, of a much, much larger pie. And that also it gets us very excited. We see this pattern in Japan, starting to emerge in South Korea, but it's definitely happening here.
What is the best way to bet on the affluent, emerging middle class of India? Autos, consumption, I mean, what is the best way to really bet on that?
We express that in our portfolio in many ways. Hospitals is one of them. Okay. So if you look at most hospitals now, private hospitals, the general ward used to be more than a third of their patient population. Mm-hmm. That has now come down to 15%. It won't be zero, but it's rapidly coming down.
Isn't that sector regulated? Every time something goes up, you've got a notification coming from the government, okay, this is the charge slip. You cannot charge beyond that. It's happened in knee surgery. It's happened in heart surgery. I think there's a notification in terms of how much you can charge per bed also. I mean, isn't that sector runs a regulatory risk?
There's some regulatory risk, but what we have seen over the last 4 years, coming out of COVID, is that in certain sectors, the government has been very thoughtful in acknowledging what they can do on their own and where they need the private sector. So if you look at, we were talking about EMS earlier, if you look at the air conditioner industry, compressors largely still come from China. That part of the supply chain has not been targeted because there's no...
air conditioners 10 times already.
Sorry. Yeah. Oh yeah, I know.
You want to switch off the air conditioners here on the interview?
Keeping track.
Should I get the air conditioning on? I don't know how far.
Well, it depends on which brand it is. Depends on which brand it is.
You tell us which brand you want.
But so there's certain supply chains that are being shifted to India and are being subsidized and encouraged to come here, and others are not. Same thing in the hospitals. The realization coming out of COVID was that we need the private sector to do well. Every once in a while, yes, we're keeping a close eye on profits, pricing. Where's the growth coming from? Is it from patient volumes or from pricing? But there's still a lot of growth ahead.
Deepika, I guess Vikas must have got Coldplay at some of the global venues that they've already performed at. Yeah. But just going by the kind of frenzy that there is, I mean, I'm not just talking about Coldplay. It also gives you a sense of that, feel-good factor out there. Just so many concerts and the kind of demand that's happening. Yeah. What's that telling you about urban consumption? Is that a trend which is here to stay? I mean, you did talk about airlines briefly, but what about expanding it to other sectors?
So definitely, I mean, we see it in our daily lives all the time, whether it's quick commerce, whether it is airlines themselves. Every plane any of us have taken in the last months, it's always been full. International travel, domestic travel. So hotels, for instance, I think there was some concern that hotel rates have peaked out, but what you've seen even at these peakish rates, occupancies are so stable. You've not seen them dwindling at all. And as India becomes a larger part of global supply chains and things like that, you'll see a lot of foreign travel also coming into India as such. So I would say hotels, airlines, discretionary consumption, all of which is not unfortunately present in the listed space, but we can see evidence of that, and real estate.
What is the outsized bet in your portfolio where when you go to your investors, you would say, look, market is positioning X, my positioning is Y, this is an outside idea, and if you give us the opportunity to manage money, we would be able to give better returns because of this outsized idea. What is that?
So we have several active bets in the portfolio which are well above what's constituted in the benchmark. If I list a few of them and let Vikas add more, but it's banks, private sector banks, hospitals, airlines. I would say
Air
these,
conditioners also. I'm
and air
sure.
conditioners also. Yes.
And auto banks.
And auto banks. See, you know all of it now. You don't need to ask the question.
Yeah, that's how we're positioned.
How many stocks do you own in your portfolio?
We have 70.
70 stocks?
70, but it's
Okay.
come down. Because again, for portfolio construction reasons, if we can own something, if we don't have a view, then we'll make it neutral until we do have a view. So there are some of those smaller bets, but that number is coming down.
And top 5 stocks, how much are they part of your allocation?
Well, as the active bets are concentrated in the top 8 for us. They represent the lion's share of the active risk budget that we have. But I will also say the reason that typically the number of stocks for us is, let's say, between 55 and 60. It's crept up because of our participation in some of the IPOs. And as you know, the anchor allocations are quite competitive. So we get something, we're locked up in it for 3 months or 6 months, pre-IPO opportunities. We don't intend to sell most of them, but some of them we do. If we get a very small allocation, you cover it every day, how competitive that process is. So the number is a little bit higher, but it'll start coming down again.
And out of the 70 stocks, how many companies have made it to your portfolio in the last 12 to 18 months, which are pure fresh additions?
In the last 12 weeks?
12, 18 months.
12 to 18 months?
Yeah.
Oh, the small and mid-cap, there's a constraint on the allocation that we can make to that. We're not at the max, but it's the highest that it has been. It's doubled over the last 12 months. Deepika joined in September. We've been going through a lot of sectors. We've gone down the market cap curve. So a lot of the new additions have happened there. And though we take very long-term views, if you use defense as an example, Aisha and I spoke the day of the election results. And at that point, we had materially reduced our exposure to defense. Since then, that sector broadly has materially underperformed. We still like it, as Deepika mentioned, for the long term. That is a theme that will be around for a long time. I wouldn't be surprised if the next time we speak, our allocation to defense has changed and increased a little bit.
All right, lots of key takeaways and pearls of wisdom there. Buy right, sit tight, and let time and multiples do the work for you. That is the word coming in from the top brass at M&G Investments, talking about how construction, engineering goods, premiumization, select private banks, that's where there is quite a bit of interest.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.